Morning all. Welcome to the start of a new month. Welcome to autumn. I think it's meteorologically autumn, 1st of September. 21st of September if you're astronomical. So August, wow, interesting month, wasn't it? I know we didn't have a session last week because of the bank holiday, but here we are. So there's a reasonable amount to talk about, really, but the major swoon from early on in August. I mean, this is the NASDAQ. I mean, it was the same in the S&Ps, same in the DAX, 40, not quite the same in the FTSE, not quite as sensitive, but we've recovered it all, actually, in all these major markets. You might think, well, what on earth was all that about? Well, quite. I told you a couple of weeks ago that I attended a webinar from the Financial Times when they had their market specialists from all around the globe, including Robert Armstrong. Just really interesting to hear. It just told me that not even the well-informed understood why the markets fell the way they did. Adrian, it's actually Jerry with a J, but when I used to run a Forex business in Dublin, and they called me Gerard with a G. Gerald. Anyway, I'm not. I'm a Jerry with a J, short for Jeremy, actually. Yeah. Anyway, we'll have a look at what happened last week. See what's going to affect the markets this week. If you remember, we had the Jackson Hole Symposium. This was this gathering of the great and the good from the central bank world and big movers and shakers. They all met in Wyoming at a place called, no problem. They met at this place called Jackson Hole, which was an old trapper's sort of place. It's called Hole because it's difficult to get out of in the winter. But anyway, more importantly, Jay Powell, the chairman of the Federal Reserve, the US Central Bank, he said that the time had come to start cutting rates. You can't have it more straightforward than that, can you? Now look, here's the FedWatch tool. We've got the meeting coming up on the 18th of September, a day before we've got our own meeting here in the UK for the MPC, and there's a 30% probability of a 50 basis point cut or a 0.5% cut. Yeah, 30% probability. So keep that in mind. Andrew Bailey, the governor of the Bank of England, or BoE as we sometimes refer to it, he said that he was actually less optimistic about further rate cuts. He said it was too early to declare victory over inflation in the UK. But anyway, markets, including the FTSE, have recovered from this what I call an early August holiday swoon, and I think it was probably exacerbated by a lack of liquidity because August can be a very, not quiet, but a lot of participants are on the beach. Yeah. Anyway, we've actually, the reason why this week's interesting is because we've got more employment data from the States. That's the thing that kicked it off in the first place. If you remember, and I'm going to quickly show you, oops, don't want them, you don't mind. That's better. I'm just going to show you the data. So non-farm employment change, yes, 114,000 new jobs created in July. That was what was reported in early August. That's what caused this massive sell-off. And at one stage, we were in correction territory. That's where the markets have fallen more than 10% from a recent high. Well, that was then. I mean, the NASDAQ struggled more than others. You notice the S&P is pretty close to its all-time highs. In fact, within a 1 or 2%. But the NASDAQ, yeah, well, we've had all those tech earnings, haven't we? We'll get onto that in a second because we need to talk about Nvidia. Yeah. Anyway, on the week last week, the FTSE was up. I think 72 points, something like that. Where's the FTSE? Yeah, modest gains, but gains nevertheless. The DAX up 319 points. Dow Jones also did rather well, also close to its eclipsed its peak actually. Dow Jones is a price weighted index, so its performance can be affected by a smaller capitalized company with a high share price. But the all-important one, the S&P 500, rather hamstrung by the tech components in it, and specifically Nvidia, which affected it. But yeah, as I said, nevertheless, a consolidating period, which is good, bearing in mind what the markets did in early August. So what caused it? What was happening last week? Well, I think the whole build up over the last week was all to do with Nvidia's second quarter earnings, and it's a bit strange really, because normally we don't have that much of a focus on quarterly earnings. Yeah, I mean I'll mention them in my spiel just to let you know when there's the big ones coming out, the mega caps, which clearly have an effect on the markets. But this attracted everyone's attentions, and it's usually reserved for sort of interest rate decisions from the Federal Reserve, employment data like the non-farm employment data we're getting at the end of the week. But you can understand, because the market was quite rightly very focused on the chip makers' earnings, because its shares are responsible for a quarter of the S&P 500's gains this year. A quarter, one stock responsible for a quarter of all these gains since here. How astonishing is that? How worrying is that? That's something we call market breadth, or lack of market breadth. So, yeah, I mean, they're up about, who's just asked that, David? We're up about 160% on Nvidia, I'll try and recall from my previous notes. And it's worth, well, it was worth 3.3 trillion at one stage. I think it's worth about, not signed in. Why am I not signed in? Keep me signed in. I can quickly show you Nvidia. I think it's NVDA. Yeah. So it's got a market cap. Okay, so it's not 3.3 trillion anymore, but it has. The share price has suffered, and it was off. I think it was off 5% last week. But let me explain why. The results came in better than expected. Revenues doubled to 30 billion, and that was more than the consensus. So this is from one quarter to the next, against a consensus of 28.7 billion. Whilst its earnings per share, that's something that the market really focuses on, was 68 cents compared to 65 cents consensus. So you might be forgiven, actually, for wondering why on earth the share price fell on the news. And actually, by Friday night's close, I think Nvidia stock was about 5% lower than before the results. I don't find it that easy looking at this. I think if you look at look on the chart on the FT, yeah. So yeah, about 5% lower. Yeah. Anyway, the hype that surrounds Nvidia is really difficult to shake off, because everyone knows about it. It's like a bellwether for AI, and this is real business AI. It's not like crypto. This is proper. This is going to change business for the better. Some people think for the worse. There are risks with AI, but it really is a main barometer on the health of the boom in AI. And I think the problem for the firm is that I know plenty of people who trade it, and many of its newest shareholders are used to sort of big blockbuster blowout reports that I think just didn't happen this time. And I think analysts may cite the outlook for the third quarter, and it was something that when the board was sort of talking about, I forgot the CEO's name now, but he's a pretty well off guy now. Yeah. It was less than I think those sort of evangelical followers Nvidia were expecting or hoping for. And I think despite the small hiccup in the share price, down 5% on the week, I think Nvidia still remains one of the mega caps, obviously, with that valuation. What was it 2.93 trillion? Anyway, away from Nvidia's earnings, Fed watchers were pleased also with this PCE. So I'm going to go back to the calendar from last week. So what they were pleased with was this. So this is the core personal consumption expenditure. You might think, gosh, this is another mnemonic. I don't know what it all means. This is another measure of inflation, but it's a measure of inflation that the Federal Reserve prefer to the regular number, the regular CPI data, the Consumer Price Index data. Anyway, that came in, actually it was as expected at the plus 0.2% with an annual rate of, it doesn't actually show it here. That's what, where did I get that from? Anyway, with an annual rate of 2.6%. Anyway, the annual rate was a little bit below consensus of 2.7%. So this helped the markets. Why? Because the Federal Reserve are going to be meeting on the 18th of September to decide how much they're cutting interest rates by. If inflation is under control and heading lower, they're happier. And clearly, Jay Powell, the chairman of the Federal Reserve, made his own thoughts well known at Jackson Hole Symposium when he said the time has come now to start cutting rates. That far out. This rather flew in the face of that employment number we had a month ago, but I always thought that was weird, the market reaction. It's like talking about one swallow doesn't make a summer, one swallow doesn't make a recession. But anyway, the numbers were supportive of that first rate cut at this upcoming meeting. And I think the debate that we're going to be having now, and it really depends on what happens at the end of the week with the non-farm employment data in the States, but the debate now is, will it be a half or will it be a quarter? At the moment, there's 70% probability that it's going to be a quarter. But if you hover over this, put your cursor over this bar and look down at the bottom, you can see the probability of a 4 3/4 to 5% cut, which would be a half a point cut. A month ago, 74%. That was in the throes of the panic. It was panic, pandemonium, panic. People thinking that, analysts thinking that the US was going into a recession immediately on the basis of one number. Very odd. Really, really strange. Anyway, the whole thing has flipped around. Now there's only a 30% chance of a rate cut with a 70% chance of a half point rate cut with a 70% probability of a more regular quarter point cut. UK markets, yes, I'm sorry, I know you want to have a look at those. So FTSE, yeah, well, it's not as spectacular. It's not laden with tech stocks, so it doesn't suffer the benefit and the bumps in the road that we've had in the tech sector over the last few couple of weeks. But they rallied further last week, better than expected PMI data, which jumped to 53.4 from 52.8 in July. And this growth data really continues to defy predictions, really, as growth, it does continue apace, and I think we're at the top of the league of the G7 for now, and without impacting inflation yet. Obviously, the downside is that the probability of a rate cut in September has reduced, and that's the reason why you've seen sterling climb the way it did, not last week, but certainly, not part of last week, but it had been climbing really ever since the middle of August as analysts sort of pared back some of their bets on a rate cut in September. And I think it's possible we might have to wait until November for the second rate cut. Obviously, we've already had one from 5 1/4 down to 5%. Not sure, I'm not that keen. I quite like higher interest rates. Personally, I suspect most of you do as well, do you? Possibly. Anyway, currencies quickly. Just look at the dollar. Recovering. Yeah, it recovered some of the lost ground. Certainly, it's lost a ton of ground since July, hasn't it? Yeah, look at that. Really down on the back of expectations of rate cuts in the US. But I always found it rather odd, bearing in mind that the US economy is probably the strongest global economy. The fact that they're having to cut rates to engineer a soft landing and prevent a recession. You just think, well, what else is happening in the UK? Or more importantly, in the Eurozone? It's not exactly doing well. I mean, the German economy, the powerhouse of the Eurozone, is in a pretty poor state, especially its manufacturing sector, which has still got a hangover stroke headache from the energy crisis and inflation brought by, well, it already started before the Ukraine war, hadn't it? Yeah. Anyway, currency traders, they've taken out some big sort of bearish bets on the dollar, which really drove the dollar to its low levels that you can see on the chart here back at early on last week. I think the question is, as I've just said, is the US, if the US is likely to be engineering a soft landing, what are the prospects for the Eurozone, for the UK, where growth has been weaker, although not so weak in the UK, as I've just been saying. Anyway, the outlook for relative interest rate cuts in both economies, I think, prompted this wave of profit taking that you saw at the end of last week. I think it's probably more profit taking rather than anyone sort of convinced that rates are going to also tumble in the UK and the Eurozone. But it's something you have to bear in mind. Commodities, gold. Well, gold, yeah, it's really it held steady last week in the face of a rebound in the dollar. Normally, a stronger dollar would normally cause any dollar-based commodity to fall. So you could say gold did okay, holding on there. Oil markets, yeah, it's all a bit volatile, isn't it? Up and down, up and down. They had a volatile 2 weeks, so we didn't meet this time last week, but the news of a shutdown in Libyan oil exports originally pushed oil right up here, where my cursor is. But I think, you've also got, obviously the market's been supported by the increase of in risks to this escalation in the war in the Middle East. And you just think Iran and Israel have sort of upped the sort of rhetoric a little bit, but I think the US is doing a pretty good job for now by de-escalating some of those tensions. But I think, expectations of a ceasefire really remain quite low, although what's happening in Israel is interesting, with this general strike today, trying to force Benjamin Netanyahu's hand in negotiating some sort of release of the remaining 101 hostages. That's it. Yeah, let's get on to the calendar. Are you all with me still? You've been quiet for several minutes. Yeah. Any questions? Please let me know. Anyway, important week for the markets. If I get onto the right week, might help. Still here. Thank you. All good. Josie, fantastic. No, I just don't like talking to myself, but I'm happy if I'm covering it well enough. If you've got any questions, please just interrupt. It's fine. Anyway, so an important week for the markets. The release of this non-farm employment data. That's how they describe it in the US. They don't report on the farming sector, which is far too seasonal and distorts the numbers. So it's called non-farm. I don't know why they don't call it core. Call it core. Everything else gets the moniker core, where it sort of removes something. Anyway, they call it non-farm. It's Labor Day today, and you've probably noticed how quiet things are. I noticed oil had legged down and it's sort of attempting to rally again. But the markets are particularly quiet at the moment. I've been looking at all the forex markets. So when there's a federal holiday in the US, obviously markets are all closed in observance of the this day, it can reduce liquidity in other international markets, especially in the afternoon. So that's something that yeah, you've got to take into account. But sometimes if you do get something interesting that happens, some sudden change in the Middle East with the US close, you can get a bigger reaction to any events that might take place today. So please keep that pencil sharpened. Tuesday, so nothing else apart from just reporting the Labor Day bank holiday on Monday. Tuesday, we've got this ISM manufacturing PMI, two mnemonics there, Institute of Supply Management. They gather data from the manufacturers, and it's from the purchasing managers, and that's what PMI stands for, the Purchasing Managers Index. Anyway, cut a long story short, it's a survey of the manufacturing sector. Less than 50, the sector is contracting. Above 50, it's expanding. Last month's data, 46.8. What a shocker that was. That was the lowest since December last year. I think the energy and inflation shock, that we all suffered from, that really hit the manufacturing sector really hard in the developed world. Look what happened in Germany. And I think few economies with large manufacturing bases have seen much of an expansion in this sector. Anyway, we're expecting a bit of a recovery to 47.5 following August ghastly 46.8 data. I think the dollar might be a little bit sensitive to that as we approach this first rate cut this month. What else we got? Monetary policy hearings, not given a high impact description from Forex Factory, but I think it certainly is. Certainly here in the UK it is. So this is where Andrew Bailey, the Governor of the Bank of England, I think he's accompanied by Hugh Pell and another one or two members of the Monetary Policy Committee, and they present the Bank of England's outlook on growth, inflation, etc. to no problem, Gary. Yeah, that's fine. Sorry, I'm whittering on a bit. Am I? No, it's only 15:15. Anyway, Gary, have a good day. So they present their outlook on growth and inflation to what's called the Treasury Select Committee. Anyway, it's in Parliament in Westminster. Sterling and UK assets, I think, will be quite sensitive to what Bailey says, because he's the one that felt that inflation still is not under complete control, that's what his comments were. If you remember what I said at the beginning of this, when Powell was very adamant that they're going to start cutting rates, but remember Andrew Bailey saying that it was too early to declare a victory over inflation. Well, maybe a couple of weeks have passed and he's decided maybe it is. Who knows? Anyway, that's the monetary policy hearings, and I think sterling and UK assets will be sensitive to any hints about a cut on the 19th of September. So that's something to look out for, please. We've then got the interest rate decision from the Bank of Canada, or BoC as it's called. Almost certain rate cut. They've had some not too good GDP data, not too good jobs data in Canada. So it's a bit of a shoo-in, actually, that they're going to cut rates from 4.5% to 4.25%. You can see the trajectory of rates. If this happens, this will be their second cut in as many months. So the Canadian dollar and Canadian assets will be definitely sensitive to this announcement at 2:45 Wednesday. Yeah, normally you don't really focus on it because the Canadian Bank of Canada tends to follow what's happening in the US, but not this time. Anyway, the CAD will be any CAD pairs. Just bear that in mind. Thursday, we've got ADP employment change. Yes, it does normally come out on a Wednesday, but because of the bank holiday today, ADP, the payroll company, are reporting their data a day later on Thursday. Still comes out at 1:15. It's not so important. It tends to have less of a market impact. Looking for 136,000 new jobs after 122,000 last month. Yeah, I Yeah, I think the market may be a little more sensitive to this data because of the last month's Bureau of Labour Statistics report. That's the non-farm report. But yeah, I think the big one is obviously Friday. And then we also have on Thursday, we have the ISM services. So we talked about the manufacturing earlier on. This is the service. So an economy is made up of services and manufacturing. The service sector is very big here in the UK, about 80% of our economy. In the US, it's not quite so big, but it is bigger than the manufacturing base. And you'll see that, yeah, we're looking a gradual slowdown actually in the services sector as well. And I guess this is what everyone's been talking about as the economy plays out that soft landing that many were anticipating as well. If you've got manufacturing below 50 and services fall below 50, effectively that's the whole economy contracting, and that's something that a soft landing would be a gradual slowdown without contraction. So we wouldn't want to see that go below 50. Yeah, dollar sensitive to that. That's right. And the pièce de résistance is the non-farm employment change or US employment data to you and me, or core US employment data. The key thing to look out for is the number of new jobs, 164,000, possibly, yeah, maybe a bit more than that even. And I think that ridiculous number, well, I say ridiculous, that's what was reported, but I think there might be a revision to that. So not only keep an eye out for the data published for August, but there may be a revision for July as well. But of course, you know, everyone speculated that the US was entering a recession this time last month. And, you know, one number doesn't spell a recession, of course, but the markets will be keen, really keen to see that the data matches or beats consensus. A weaker number, would probably see the dollar fall, you know, because I'm sure traders would then likely price in a higher probability of a half-point cut later this month. Yeah. Employment data, unemployment rate at 4.2. That's not so important because it's affected by people entering and leaving the jobs market, really. Average hourly earnings is something that the Federal Reserve will be focusing on, plus 0.3% expected there. Who's it going to affect? Obviously the dollar, obviously US assets, but global assets as well. It'll affect, it'll affect our markets here. It always does. It'll affect the DAX, the CAC, the Nikkei. Yeah. What happens in the US really has a big effect on global markets. So this something as important as non-farm employment change, absolutely it does. That's it. 9:20. That's okay, isn't it? Free to focus again back on the markets. It is quiet today though with the Labor Day holiday in the US. Listen, have a very good rest of the week. We are around again, at least I am definitely around again next Monday. So I look forward to catching up then. Political change in Germany, says Michael. Yeah, I don't think many parties are going to want to lie down with the AfD though. Yeah, it's been a while coming, hasn't it? But yeah, I mean, some Germans are quite worried about it, but let's see. Catch you, yeah, 8 a.m. next Monday. Bye for now.